The Reserve Bank of Australia have officially increased the cash rate by 0.5%. Today, we're going to look at what this does to your payments and, more importantly, how it decreases your borrowing capacity. So let's jump in. And to keep up to date all things property finance, remember to hit that like and subscribe button. With the Reserve Bank of Australia increasing the cash rate by 0.5%, immediately this is going to affect what's called your assessment rate. And this is essentially a rate the bank looks at to consider how much you can afford. It's essentially putting a buffer on the interest rate you receive. So if, for example, your interest rate on offer is 4%, the bank will apply a buffer. That's the assessment rate buffer. At the moment, it's a 3% buffer on the rate you're given. This will then mean that the banks will assess you based on a 7% interest rate, not the 4% you're receiving, because ultimately, they want to make sure you can afford the mortgage both now and in the future, and this is exactly what the assessment rate does. It allows them to make sure they're lending responsibly. Looking at this example here, we've got a couple who have 2 children and are earning $75,000 and $120,000 respectively. And looking at a current assessment rate of 6%, we can see that the borrowing capacity is $1.25 million. If I go ahead and increase that to 6.5%, we can see that that's decreased that by almost $70,000 to $1.88 million. And this is the exact impact the cash rate will have on you, because ultimately the higher your assessment rate is, the lower your borrowing capacity becomes. And if you've got a pre-approval, one of the things you'll want to do is talk to your banker or broker and find out whether or not this rate increase will affect your borrowing capacity, because there's 2 types of lenders. There's lenders that will consider your application locked for 90 days. That means even if the assessment rate goes up, they will honor your pre-approval based on pre-approval date. And there's those banks that don't do that. So essentially it means that any changes to the rates or assessment rates will have a direct impact on your borrowing capacity. If that's the case, you want your bank to reassess your application so you know exactly what your limit is. Now let's take a look at what this 0.5% will do to your repayment. So if you have a mortgage of $500,000, an extra 0.5% will mean an extra $151 a month. Now, if your mortgage is, say, $750,000, let's take a look at what that does. That'll increase your repayments by $226 a month. And finally, if you have $1 million mortgage, it will mean an additional $301 a month. And one of the things to consider is looking at a fixed rate, because ultimately a fixed rate will mean that your rate is locked in for the term. So if you've gone for a 4-year fixed rate, it'll mean that for the next 4 years, even as rates increase or decrease, your rate will be locked in. You'll know exactly what your repayments are per month, every month. And you won't have to worry about whether they're increasing or decreasing. It is a really great option if you have a tight budget and want to know exactly what your repayments are for an extended period of time. And if you do have a mortgage, it's a great time to be looking to refinance, because a lot of banks are offering refinance rebates between $2,000 and $4,000, essentially meaning you can switch providers. All your fees and charges is covered by this rebate, and this will allow you to do 2 things. If you are looking for a fixed rate, looking at the best fixed rate option, or alternatively, if you're just wanting to review your home loan to make sure it's still competitive. And if you're thinking of refinancing and looking for a great mortgage broker, here at Hunter Galloway, we can help. We service across Australia and don't charge a fee for our service. So reach out and visit us at huntergalloway.com.au or call us on 1300 088 065. Thanks for watching, and until next time, I'll catch you then.